Hi, everybody. This is Kelly Olczak, and I'm really glad you guys are here for our presentation today. Kind of timely. I started creating this in March, not knowing how volatile the markets were going to be. So I'm really glad we're going to touch on a couple of things that I know people are thinking about. I think you guys will notice that we have a dog theme, like we always have a dog theme, but Becky said earlier, why is that not Lydia? Yeah, getting my dog on a surfboard. Again, thank you so much for being with us today. I'm Kelly Olczak. I'm the managing partner of Lindley & Company, and we manage the finances for a handful of families in the area. I'm excited to say that we are 100% woman-owned, registered investment advisor located in the Bushnell's Basin in upstate New York. What does a registered investment advisor mean? It means we're fiduciaries. And that means that we always have to do what's best for you, regardless of whether you work with us or not. Also, I am a certified financial planner, and I've held that designation since 2009, which is kind of weird. Seems like a million years ago. Joining me today is two folks, Chaz Miller, our operations manager, and my partner, Becky Gillette, who is our dedicated chief compliance officer. Chaz is going to be our Vanna White today, and she is going to help with any questions that you might have via the chat function in Zoom. So feel free to raise your hand, ask questions throughout this presentation. One of my favorite things to do is to educate folks on investing and important things around financial planning. And our intent has always been to help you guys become better, more informed investors. We only have one polling set of questions today to kind of just set us up for understanding who is joining us. Chaz, would you do me a favor and launch that, and then we will get going with the presentation.
Just sent that out. And that's a great question, Sally.
Oh, yeah.
What
Becky,
is a compliance officer?
this is your question. Let's let the folks answer the questionnaire, and then Becky, I'd love it if you explain what that means to our clients and potential clients. You're right, Chaz. Nobody asked that question. They just said, okay, whatever that means.
I'll give it another couple seconds.
Great. Terrific. Okay, let's get going. So let's start with the basics. We're going to get into some parts of investing that I think are important for people to know, but I like to start with some foundational knowledge. We're going to start with some basics of what inflation is, what market volatility really means, and why it's important for you as an individual investor. So what is inflation? So inflation is a term we've heard countless times over the past couple of months, maybe even a year and a half, but let's demystify it. Simply put, inflation is the rate at which general levels of prices for goods and services are rising, and subsequently what your purchase power is reduced by. So purchase power, how much of a particular product you can buy for $1. It affects everything from our daily coffee to your investment returns. So there are several causes of inflation, from increased production costs to higher demands of goods and services. So production cost is, your RG&E bill went up. Uh, different services that you pay for to get those goods and services out. Then on the higher end of services, especially with like maybe real estate, if there's not a lot of inventory, the prices do increase. So understanding these concepts can help investors anticipate changes in the economy and help adjust strategies accordingly. So let's take a quick journey through history to see how inflation has shaped economies and investment landscapes across different eras. This will help us understand the cyclical nature of inflation and its long-term impacts. So from the roaring 20s to the recent pandemic, we've seen inflation spikes and diverse causes behind them. Each period offers a lesson on how economic policies, global events, and tech advancements influence inflation. So if you look at these events, we have a client who said to us one time, I remember when CDs used to be 12%. And I said, well, Frank, that's adorable because your mortgage was probably, 24% interest. He goes, nope, I paid cash for my interest. So I guess that was the good old days for Frank because his CDs were 12% and he didn't have any debt. So what is market volatility? Bumps. Think of it as bumps. It's a measure of how drastically your investment prices can change within a short period of time. It is a natural part of investing. I know a lot of people have seen, especially at the end of last year, our investment returns come back very strongly. And just in the past couple of weeks, we've seen some downward movement. But that's the natural cycle of investing. I wish that it would always go straight up, but it won't. So we are going to talk about ways to kind of help you approach an understanding of what these things do to you and your investments, and hopefully help you not be so stressed if you are stressed about these sorts of things. So as I mentioned, market volatility is simply how much prices of stocks or other financial assets go up and down. Here's a breakdown of a chart. I really, really love this chart. I can't tell you how many times people are saying, oh my God, the market's going straight down. But here's a breakdown. This is a slide from JP Morgan, the resilience of markets. And even though there are often dips throughout the year, markets generally bounce back. So if you look at this chart from 1980, you're going to see almost every single year the market was down during the year. So the way to identify and understand this chart, the gray bars are how the market ended at the end of the year, okay? The negative numbers below the zero line are the downward returns during the year for the market. So if you counted, you'll see that since 1980, we've had 10 bad markets. But it always feels like the markets are bad. There's a pattern of recovery here. So looking back at this data from 1980, it's clear that despite facing numerous downturns each year, almost always, except for 10 times, the year closes in a positive manner. And that underscores why it's important for us to keep your investments in place when things seem shaky. The average declines, on average, markets have seen a decline of about 14% a year. This is where those red numbers are. But it does help us understand the importance of staying on course based on your individual goals for your investments. The ups and downs are always going to be there. This chart will help you. And I actually have sent this home with a couple folks. So in the middle of the night, if they're really worried, they look at it because ultimately, although we can't tell the future, the trend has always been in a positive manner. So what are the lessons that we learned? This slide talks a little bit about each one of some really crazy things that happened. So the Great Depression. The lesson learned during that period of time, it highlighted the need for regulatory frameworks and significant impact of market speculation and bank practices. What you're going to find with these 5 things that occurred, there is after the event, we learn from it and make changes. So banking regulations were important. FDIC insurance was important, so that you knew that if you had to go to get money out of your bank, a portion of your savings were insured. So the next one is Black Monday. This happened in 1987, and the market dropped suddenly, and it was due to program trading. We were becoming more automated. The lesson there that we learned was the potential danger for automatic trading and the importance of having what's called circuit breakers. So now what happens is if the different markets do different things, trading stops. So that's what a circuit breaker means. And it will help panic selling, people selling out because they're scared. Then if you probably remember the 2000s with the .com, that was the new economy and the market was always going to go up. Well, then eventually it did not. It did emphasize the risk of overvaluation in new tech, the new economy. You may remember the global financial crisis, 2007 through 2009. That was really tedious for everybody because stocks and bonds were affected, and there really was nowhere to hide. Normally, when a market corrects, stocks are doing better or bonds are doing better. So if you're in a bond market and it corrects, your bonds did bad, but maybe your stocks did well. So the lesson learned there was to understand the interconnectedness of not just our market, but global markets. And that did encourage much stricter oversight in financial instruments. And of course, we just got through the COVID situation, and this was whiplash. I mean, it was remarkable to see how fast the global market was impacted. And I've got this little window that's in my way. Yes, I do cheat and read my notes. But the latest market incident for COVID, what that really emphasized was the importance of diversification and adaptability in investment strategies, meaning you don't go to cash, you just change the types of investments to stay in the market, but reduce risk. Okay, so understanding how inflation and volatility affect investments is totally important. I've had clients come in, I like this slide for a couple of reasons. But I've had clients come in and say, I just had a meeting last night, got a client with about $250,000 in cash, and he is very worried about the current market environment, mostly because of the election cycle. But I can tell you almost every year, there's always something. So this one individual said to me, I just want to put my money somewhere it's safe. And I hate to break it to people, there is no such thing as safe. So I do have a friend who's an advisor who had a client said he wanted to buy a bond, and he went out back and literally dug up a mason jar. I'm not lying. Becky and I heard the same story from this guy, and the client came back with a mason jar of $100 bills. And Jerry said, I can't take cash. But the thing is people were worried. They worry about cash, so they put cash away because they can touch it. Well, inflation erodes your purchase power. We talked about that a little bit. So if you think about housing prices, we've got people out there selling houses that are maybe worth 250 and they're selling them for 350. Well, when the market corrects, that house is not going to be worth 350 anymore. I think there's a new message. Oh, Becky, I'm sorry.
That was me. I will rewrite that because I think it just went to you.
Okay, okay. Actually, I'll finish the slide and then I do want you to answer that. I get in my groove, Beck. I got the slides and I'm gonna do it. So,
That's okay.
Inflation, how it impacts a dollar. Our gas prices are a good idea. Grocery grocery store purchases, RG&E bills, they change because inflation is more expensive, so your dollar doesn't go as far. Bond prices, generally bond prices fall, meaning how much you can buy a bond for, when inflation rises. As a fixed income for bonds becomes less attractive compared to higher prices. So if you bought a bond for, say, $10,000 and it was paying you 3% maybe 5 years ago, and you can buy a bond right now. I just did this yesterday for 6%. You don't really like your 3% bond anymore because you can go out and get a 6% bond. Well, if you go to sell your 3% bond, you're not going to sell it for the $10,000 that you purchased it for, because nobody's going to buy a bond that only pays 3% when they can get 6%. So the stock market, it's mixed actually, because sometimes a certain part of the stock market does better than the other, but it fluctuates. And this is where people think there's a lot of risk involved. But stock market is very important because it does keep pace with inflation. Bonds do not keep pace with inflation. The dollar does not keep pace with inflation. We right now are in an environment, have just come out of an environment where we had 9% inflation. It was short-lived, but I don't have anything guaranteed paying 9%. Okay. And of course, real estate. We've seen what's been going on with real estate. So volatility affects short-term and long-term investments differently. So a short-term investment, now this could be a stock or a bond. When I say short-term, I mean, if you have an investment and you are going to need that money in a short period of time. So if you bought an investment, a stock, and knew that you were going to need to use that money to buy a house, probably putting in a stock is not a good idea because you're going to need that in a short term. And the pricing fluctuations are going to be much more bumpy than if you put it in a money market. So the goal, what I like to say is the goal of the money defines the type of investment. So short-term investment is anywhere between, 3 days to 5 years. Long-term is anything after 5. The long-term investment tends to be more stable. It's able to ride out the market volatility, even though it bumps all the time. So the consideration you have to make is the importance, and this chart is really, really neat because it does talk about all the different kinds of investments you can have, from cash to large US companies to junk bonds to real estate. And what I like about this slide the most is it goes back to 2009, which is right after the financial crisis. And it shows us how different types of investment, whether it's emerging markets or international or bonds or cash. And then you're going to see this white box that says asset allocation. And that's a blend. That's the diversification. And I'll get into that deeper. But if you look at the top of this chart, 2009, you see EM equity. That's emerging market equity. So in 2009, this is right after the 2008 crash. Emerging market did 79% that year. The following year, it did 19%. The year after it did minus 18.2. So it's a roller. You buy one thing, it's a roller coaster. What this slide does is say it's important to have a mix of things. Any questions? So the importance of understanding returns that are what's called nominal versus real. real returns means taking inflation into consideration. So a nominal return is the percentage increase in your investment without adjusting it for inflation. So you'll see this chart, 6% return over, 30 years without inflation looks fantastic. But we always want to take into consideration how inflation affects it. Now, before COVID, no one cared because we barely had 1.5% inflation. But then we had this correction. So it's very important to understand the way inflation will impact the value of not just your portfolio, but also the value of your dollar. Okay, this slide is hysterical. We're going to talk about volatility as a measure of risk, but this slide is literally could be my son and I. I'm the one screaming, mostly because he makes me go on the same roller coaster over and over again. But volatility is different for different people. So I have some people that love volatility, where they don't care about how much risk they take. That's my son. Versus me, I want to be on the merry-go-round, which is gentle and more predictable. Okay. So let's talk about strategies to navigate inflation effectively. There are several strategies that investors can use to protect their portfolios against inflation. And if you are a client of ours, that's part of what our job is to help make sure that your investments are balanced in a manner that meets your individual goals and also takes into consideration the types of investments you own that might not be negatively affected by inflation. So we're going to look at a couple of those things right now. Diversification is the most important thing that we can think about when it comes to market volatility and investment strategies. So you don't want to put all your eggs in one basket. So this chart is a illustration of what a 60% equity portfolio, 40% bond and cash portfolio returns might look like, okay? And again, this goes back to the 50s. And if you count it, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 13, 14, 15. So there's about, it's about every 3 to 4 years, we have a negative return. This is a long-term view, obviously, but it does illustrate the importance of not having all your eggs in one basket, because sometimes bonds will help your portfolio do better in the years that stocks are not doing well, and vice versa. Now, when we were in 07 to 09, as I mentioned before, there was nowhere to hide. That was a unique environment where stocks and bonds were really affected very badly at the same time. So we're just going to call that a black swan event, meaning that's not a typical event. Effective budgeting and saving become more crucial in times of inflation. Prioritizing needs over wants is important. And we, you may know, may not know, we work with about 90 families. And out of those 90 families, about 54 of them represent 87% of the assets we manage. Personally, I manage about $73 million. And I, as a financial planner, always start relationships with a financial plan, because if I don't know what the money is supposed to do, how on earth can I give you good advice? That being said, everybody hates the B word, budgeting. Budgeting doesn't mean this is what you're allowed to spend. Budgeting means every dollar has to have a home. So I'm a big fan of the uh-oh bucket. Uh-oh, the water heater broke. So I help folks figure out what their 3 to 6 month emergency bucket needs to be. And we start saving there. I will not touch people's money, like non-IRA money, if they don't have a 3 to 6 month uh-oh bucket first, because when we put money into the market, now that becomes a long-term investment. So we start with that short-term investment. So these are things that we can do And some of them seem quite simple, but putting it all together is part of that really nice understanding when the market does do something stupid, you're okay. Any questions? This strategy really allows us to figure out when it's time to make a good move, a wise move in the market. We've covered all of our bases. So managing risk in volatile markets. So everybody is different. Everybody's risk tolerance is different. And so the concepts we're going to talk about are big, broad brush strokes, okay? So I like to think of it as, how do I let you sleep better at night? The potential for losing some or all of the money you invest really can help people lose sleep. So we don't want all of your investments to be in something really risky. I've had clients come to us and say, I need to invest some money because I'm late. I haven't saved enough, so it needs to be risky. And I think the reason people will say that is because they see these stories on the news where, you know, GameStop, somebody invested in GameStop or Bitcoin, and they bought it at $1,100 and it went up to $60,000. Wow, that's amazing. That's terrifying. That's not a good idea, because they put a bunch of money in one thing, and that one thing can be very, very, very bumpy. So all investments, as I mentioned earlier, do carry risk, and each has a different level of risk. What matters most to you is what your situation is. So you have to consider your income, your expenses, your debt, your uh-oh money. And then we define what your goals are. So some folks want to buy a house. Some folks want to retire soon. A lot of what managing risk has to do with is making sure you have your own personal comfort level. Now, time horizon is very, very important. So I have a client who has 3 kids, and they're in their early 60s, not the kids, the husband and wife are in their early 60s, and the kids are in their early 30s. If I ask those 2 groups to take the risk tolerance questionnaire that we use, they can answer the entire thing exactly the same, except for time horizon. And the risk profile will be terribly different, because mom and dad need the money now. The kids have 30 years before they need it. And so time horizon is so, so important. Okay, so let's talk about an example of being too conservative. So some people, being too conservative is just as bad as being too risky. So here's my guy, Nervous Ned. So once upon a time, Ned, at 30 years old, decided to start saving for his future, but he had one real big problem. He was so nervous about losing money, he put all his money in CDs. And so for 20 years, he diligently went to the bank and put his money in CDs, saying they were safe and sound. Well, he thought that those CDs, when they mature, he would have those dollars in his hand, which is true, but those dollars did not keep pace with inflation. So when Ned turned 50, he had an epiphany. He said his safe strategy actually cost him a lot, because he never allowed his money to grow with inflation. It was a little late. So it's important to consider how, quote, safe investments can hurt you. On the other hand, here's Bitcoin Bob. Yes, I made these names up. So this I've seen happen quite a bit, especially recently with things like Bitcoin and the GameStop issue. Tech investments. I worked at Sun Microsystems for a number of years, and was part of the 1999 support team for upstate New York. And there were a lot of brand new .com businesses out there. And that was the new economy, and they only went straight up. With Bob, he really liked those kinds of investments. So at 35, he was determined to ride the wave of high risk, convinced that he could snag those legendary returns that we see in the news. But what he did was he jumped from one great investment to another, cryptocurrencies, penny stocks, you name it. Each time he was fueled by a tale of overnight millionaire riches. Well, the problem is that the volatility was so big, the swings were so big. He'd have these great big returns and these great big troughs of losses. After 20 years, he was no closer to his financial dreams because of all the big ups and downs. So what we try to do, the lesson here learned is, we do not chase returns. You cannot chase returns. You will always miss the market. Wise investors will understand the value of balance, research, and long-term plans. So how risk tolerance affects investments and your choices. So discipline, how do I explain this? I love the families that we work with. I am emotionally attached to the families that I work with. I am not emotionally attached to their investments. That's why these families come to work with us, because I can encourage them to make the prudent choice to not chase returns. And that's discipline. Discipline is so important. When our clients sit down with us at the very beginning, we build a strategy based on their own needs. So I've got clients that are paying for college. I've got clients that are, late 40s, early 50s that are all of a sudden saying, oh my gosh, maybe I haven't saved enough in my 401k. I've got clients that are concerned about taking care of mom and dad. So everybody's plans are different, but the discipline and the way we approach these things are similar. Very well thought investment process with emotional checks, making sure that we're staying on track on the goals. Now, goals can change, and that's when the investment strategy would change. So we're back to this slide again. I love this slide, but it really does talk about the diversification, the importance of it. You don't want to put all your eggs in one basket. Coming back to this slide, this little, in the middle here, you'll see asset allocation. It goes up and down, up and down, up and down, up and down. It's a blend. This is a 60% equity, 40% stock, 60% equity, 40% cash and fixed income portfolio. And if you look at the far second to the right column where it says 2023, okay? Last year, US large cap growth did 26.3%. That's the best category of investments. But the portfolio did 14.1%. And I have got clients say, well, I want 26.3% and I want no downside. So do I, but you're not going to get it. But this illustrates the importance of having the right mix and making sure that the right mix that we started with maybe 3 years ago is still aligned with your right mix now. I've had clients that have been forced to retire like sooner than they thought. And so we then go in and change the allocation because they've had a life event. So rebalancing is the most important thing to making sure we stay on track. So it can mean a couple things. When folks work with us, and for those of you who are our clients already, you know this, we work with a couple research teams that help us decide what type of investments we should hold based on the current market environment. So last November, we have a very small portion of our portfolios in emerging markets. And our research team said, we still want to keep that, but we want to remove China from it because China's environment is so toxic right now that we're going to stay in the emerging market space, but we're going to make sure we don't have any exposure to China. That is an position change. So we rebalance around that position change. Another way portfolio rebalancing happens is if your situation hasn't changed. Let's say you are 60% equity, 40% fixed income and cash, but the equity side has done very, very well. And now you're like a 65-25. A rebalance there would be get you back to 60, 60-40. Or if you had a life event, like you got laid off or you need the money sooner, that's a portfolio rebalance also. And basically the analogy I like to use is it's like tidying up your investment mix to keep it in line with your goal. So if some investments grow too much and others do not, we try and keep you in the guardrails. Market volatility, which is a very big theme right now, can be your friend if you know how to use it. I love terrible markets. I know that sounds horrible, but I love a bad market. I'm a big fan of Warren Buffett, and one of my favorite things that he says is buy low and sell high. You know, when your friend comes to you and says, hey, you know, I'm doing really good in the market, I bought XYZ, and then you think maybe it's time for you to buy XYZ, you might have missed the time to buy it. So buying low and selling high is easier said than done, but it's a principle that we look to when we are rebalancing and building our portfolios. So think of market volatility as a seasonal sale. Just as you might snag a bargain during a sale and sell it for a profit when demand rises, savvy investors do the same thing. I like to tell our clients, if it hurts, if it makes you uncomfortable, we should be doing it. So what does that mean? Before the financial crisis, 07 to 09, everything was doing so well, and folks were saying, oh my gosh, why on earth wouldn't I stay in this investment? Well, it's going to pop. You can't have all your eggs in one basket. So we take gains and put them into things that are less risky to hopefully keep you on track. Okay. So this presentation is recorded, and I'm going to show you some tools and resources that you might find helpful. And if you've got any questions about these tools, I'd be happy to answer them. But there are a lot of everyday stuff you can find on the internet. Now, we do have a handful, probably 5 or 6 clients that really like to buy individual stock and really like to roll up their sleeves and are good students. And so I thought I would put this sort of thing on this presentation because, especially with inflation right now, there are a lot of very, very good ideas out there that fit into our clients' portfolios. But if you don't want to work with an advisor, where do you go? So here are your ideas. Now, we also have clients that look at these ideas and work with us. So it's not that I'm making all the decisions. I take into consideration what every client's perspective is and roll up my sleeves and work with them. The one thing I do like very much is the second to last bullet, the economic indicators. There's this thing called VIX, this VIX, and that is an index of everyday investors and their worry meter. I call it the worry meter. So when the VIX index is very high, it's probably a very good time to buy stuff because the individual investor is so worried they're selling stuff. So that's kind of a neat one. Couple books that I like, The Intelligent Investor. It's a cliffhanger, boy, but it does give you an idea of the discipline part. There are some really neat courses out there around financial markets, and I find that these courses are, even though this is from Yale, they are pretty vanilla. They're really trying to encourage people to understand financial markets. There's a website called Udemy, Udemy. I love this. Anytime I'm trying to learn some stupid software program, this is where I go because they've got bite-sized chunks. It'll be a whole course, but there are chapters and lots of visual. I'm a visual learner, so I like to see examples and videos and things like that. So that's helped me a ton. My favorite website for investing in the whole world is Investopedia. And this has really, really evolved over time. In 2005, when I was hired by Edward Jones, I had to wait to join a class, an onboarding class. And I was so excited about getting going. I bought Investing for Dummies, and I found this Investopedia website. Investopedia is a really neat website because it tells you, you could Google or you could go on the website and say, I don't understand bonds. And it'll show you a video of how interest rates change and how it affects your bond prices. With videos and infographics, it's very user friendly. Morningstar is a really neat tool. There is a free version of this. So if you wanted to go in and compare a current investment that you have against a benchmark, there's a lot of really neat tools. Yeah, this is a little bit propeller head, but if you're going to roll up your sleeves, I wanted you to at least have some good resources that I trust would give you good information. And that's it, you guys. I know that I covered a lot. I'm always worried about making sure I'm done in an hour, and I did this in 45 minutes. Holy cow. So maybe I went too fast. Are there any questions? I'm gonna, at the end of this presentation, if you would help me with the survey, it really helps us understand where we're hitting the high mark. After the video is downloaded, we're gonna send out the replay, because I know Mike and Steve, you came in a little bit later, so you haven't missed anything. And then I've got a really nice handout that walks you through the details of what we presented. So if there are no questions, I think we're done.
I think we're good. Thank you for coming. And if you think of any questions later or have a specific question, feel free to reach out and we can get you on the calendar so we can talk about it further.
Thank you.
Nice to see you again, Mike and Steve.
Bye.
Bye, guys.